All right, let's get right into it. We're breaking down a briefing from some big institutional players to figure out what is going on with the stock market. You've got these conflicting signals just pulling everything in two different directions. Just when it seemed like everyone was getting into the holiday spirit, the market just slammed on the brakes. So, is the party really over, or is this just a pause? Let's figure it out.
Okay, this one sentence right here from the Smart Money briefing, it just perfectly captures the whole problem. On one hand, that excitement we saw right after the Federal Reserve meeting, yeah, that's cooled off. But on the other hand, the big money, we're talking the institutional whales, they're starting to make some fresh bets, signaling that maybe, just maybe, this year-end rally isn't dead after all.
So what do we even call an environment like this? Well, the pros are calling it transitional/late cycle chop. And, in plain English, that just means it's messy, it's choppy, there's no clear direction, and you get these really sharp, conflicting moves up and down. One day feels amazing, the next day it feels like a huge warning sign. So let's actually dig into the evidence for all this confusion. And we're going to start with probably the single most important price level on the charts that everybody is watching right now.
Here it is, 6,120 on the S&P 500. You should think of this as the absolute line in the sand. For anyone who's still hoping for that Santa Claus rally, the bulls have to, and I mean have to, defend this level. If it breaks, well, the whole mood could turn sour really, really fast. And that could open up a quick drop down to that 6,050 level.
So what's been pulling the market down? It's really these three forces. First, you had the Fed come out with some surprisingly aggressive or hawkish talk about keeping rates higher for longer. That pretty much killed the party. Second, there was a technical thing traders call a gamma roll-off. Basically, a ton of options expired, which kind of removed a safety net from under the market, opening the door for bigger swings. And the result? That third point. Even when the S&P 500 looked flat, underneath the surface, twice as many stocks were falling as were rising. That's a huge red flag showing hidden weakness.
Okay, so now let's switch gears and see how this whole conflict is playing out in the hard economic data, because it's creating this classic and kind of frustrating paradox for investors.
And this slide just lays out the market's biggest problem perfectly. We got some really hot retail sales data. It came in at plus 0.6%, which was double what anyone expected. Now, normally, a strong consumer, people out there spending money, that's fantastic news. But in this environment, it's actually being seen as bad news for stocks. Why? Because it means the Fed has absolutely no reason to start cutting interest rates anytime soon.
And this is a concept you really got to get your head around to understand this market. We are back in a good news is bad news regime. What that means is strong economic data like those retail sales, it pushes bond yields higher, and those higher yields put direct pressure on stock prices, especially for those high-flying tech companies whose valuations are really sensitive to interest rates.
And here's the kicker. Even while the broader economy looks pretty strong, if you look at the actual companies, the fundamentals, you start to see some stress. You have big, important companies like FedEx and Oracle coming out and warning that their profit margins are getting squeezed. And with the market trading at a pretty pricey 22 times forward earnings, there is just zero room for error. It's officially a show-me market now. Companies have to deliver the growth to justify these prices.
Okay, so with all of this conflicting data, a strong economy that's bad for stocks, weakness under the surface, where are the big institutions, the whales? Where are they actually putting their cash? This is where it gets really, really interesting. So despite all those warnings we just talked about, we are seeing a crystal clear risk-on move. Money is just pouring into technology, which is the big momentum leader. It's also flowing into financials and even into consumer discretionary stocks. Now, let me be clear, this is not a defensive move. This is a bet that the economy is going to keep chugging along or even accelerate. But, and this is a huge but, at the exact same time, that same smart money is aggressively dumping the safety sectors. Real estate is in what this report calls the capitulation zone. That means institutions are basically panic selling. Utilities, which people often buy for safety because they act kind of like bonds, they're getting dumped too. It's a massive rotation out of safety and into risk.
And this divergence, this is probably the single most important clue in the whole briefing. Institutional money is making a really decisive bet here. They are throwing defensive assets overboard to chase growth and tech. And this action, what they're doing with their money, it completely contradicts the story that the market is scared of a slowdown. So all of this brings us to the big payoff question. Given this insane tug-of-war between the scary macro picture and what the big institutions are buying, how could this whole thing play out? Well, the briefing lays out three very distinct scenarios for the holiday week. But before we get to those scenarios, you've got to keep these three things on your radar this week. First, the PCE inflation report on Tuesday. It's the last big one for the year. Then there's a bond auction on Wednesday that could send ripples through the market. And finally, remember, a lot of traders are on vacation. That means low volume or low liquidity, and any moves up or down could get really exaggerated. So here they are, the three possible paths. The most likely, the base case with a 50% probability, is what they're calling the holiday grind. We basically just chop around sideways. But there's a very real 30% chance of a breakdown if that inflation number comes in hot. And on the flip side, there's a 20% chance of a Santa miracle rally if the data is cool and volatility just disappears. The triggers for each path are super clear.
But before we wrap this up, there is one final crucial piece to this puzzle. It's a critical insight from a totally different part of the market that, frankly, most people have probably missed.
So while everyone's been staring at the Fed and watching stock prices go up and down, another market, one that a lot of people think is smarter and faster to react, has been sending a very quiet but a very important signal.
And this is it: high-yield credit spreads. So what is that? Well, in simple terms, it's the extra interest that riskier companies have to pay to borrow money compared to what the super safe U.S. government pays. And that gap, that spread, it has started to get wider. So the final takeaway is this. You have stock investors who are piling into risky tech stocks, right? But at the same time, the bond market is getting nervous. It's starting to demand more money to take on risk. This is a classic divergence. And the question this briefing leaves us with is a really big one. Which market has it right? The optimistic stock market or the much more cautious credit market?